Good afternoon and good morning, everyone. Thank you for taking the time to listen to today's webinar. I'm Frank Troyce with Soho Advisors here in Singapore, and joining me today is Bob Pitti of Liquid Stock, based back in California. Bob, how are you today?
I'm doing well, Frank, and I'm excited that we had a chance to get together.
Yeah, well, and I think what we'll avoid today is the fact that now with COVID in the States, you're running around footloose and fancy free. Here in Singapore, we're quite jealous of the set of circumstances that you now have, and I hope we have the chance to get together in person soon.
Yeah, definitely.
So Bob, help us understand how, when we look at Liquid Stock, and in full disclosure to the folks listening to this, you and I do have a working relationship between our two firms. And our team has always found your proposition to be incredibly compelling. And maybe at a high level, can you give us this, why is this a focus for you now? And why has it been? And where are you seeing demand for this type of solution for counterparts going forward?
Yeah, well, what we're doing at Liquid Stock, we're solving a problem that's been around for quite a while. That just in recent years has become more acute. As we both know, private companies have been staying private longer, growing substantially in valuation in the private markets before a liquidity event. And what that's done is increased the demand for liquidity while companies are still private. You remember back, thinking the mid 90s and that time frame before the first tech bubble burst. And companies are going public very fast, and founders and senior executives and others, could see a line of sight to generating liquidity and getting some much needed capital in their pockets, just to meet their specific cash needs. And now that the average age of a private company is creeping towards 10 years, that need for liquidity hasn't gone away. And so what Liquid does is, in a unique way, kind of addresses that need for liquidity while companies are still private.
And so who at the end of the day is your target universe? So it's a private company, probably in that longer tail of their life cycle, years 7 through 10. Is the thought here that they need to go public at some point in time, and you're, for lack of a better word, bridging that for them, or is it something different?
Yeah, it's really a bridge. Ultimately, a liquidity event would be on the horizon, but the individual's cash needs are really not in sync with company plans to go public and underwriting calendars. And that the need can be very, very simple. I'm working hard. I've created a lot of value on paper. I'm worth a significant amount of money, but I need capital. I need capital to invest in other projects. I need capital to diversify. I need capital because I want to buy something simple like a home. So that need is there, and as people and liquidity events, are further on the horizon, people have been increasingly looking for ways to do it. Now, that isn't lost on private companies. They know that their employees are looking for periodic liquidity, and if they're kind of an employee first culture, companies are looking for ways to provide that capital to their employees. And what's happened is there's this market now, where companies are doing share repurchases, they're doing sponsored tender programs, they're facilitating third-party secondary type transactions, and we've seen that just increase in frequency and in size in many companies over the past 4, 5, 6 years. But what Liquid does is a little bit different. So those liquidity programs are predicated on somebody selling their shares at a price. And sometimes that price is at a discount to the last round preferred, but they're selling at a price. And a sale is not always the best way to generate liquidity from a tax perspective, and also from the perspective of, if somebody's involved in a very high profile, fast growing company, you kind of know in your heart if you sell at a price today, looking back after the liquidity event, you're going to have this sense that, wow, I really sold at a substantial discount.
Hmm.
So what Liquid is doing is providing the credit alternative up against compared to a sale.
Hmm.
So if you think about public markets, you own a publicly traded company. You own shares in Google, and if you want liquidity, well, you can go on the market and you can sell your shares. You sell your shares, you pay your taxes, you have your cash. If you don't want to sell your shares because you're very bullish on the company, you don't think it's the right time to sell, well, you can get financing secured by those shares. That mechanism doesn't fully exist yet in the private markets. So if you hold shares in a high profile private company and you want to sell, depending on the company, there's probably a secondary market for it. And that could come through a company sponsored type tender program, or it could come through a third party secondary buyer. But there are not many alternatives today to basically receive financing secured by the value of those private shares. Traditional lenders don't consider private securities to be good collateral, whereas Liquid, we look at very promising later stage companies and say, wow, that's really good collateral for a financing transaction. It's just not liquid today. So our goal is to provide financing secured by the value of those shares. And if you think about it from the shareholder's perspective, yes, you can sell today, pay your taxes, put a net amount in the bank. Clearly, you've lost all the upside. If you're a true believer in the future value of the company, if you think there's a liquidity event on the horizon, it's going to be at a substantial step up in valuation, it makes a lot of sense to consider a financing solution where you're getting the cash up front without having to sell as many shares. So basically getting the cash and holding on to more upside in the company and doing so in a tax efficient manner.
And Bob, is this there's a few things there that you said, I want to make sure we unpack them. Is this, so let's assume client X is there and they have shares in a company right now, let's just say their last valuation was at $100 million in terms of what they're holding now in stock. How should they be thinking about this structurally relative to the liquidity event? Like, so question one, are they making a guess as far as the term structure for this transaction? So they coming to you saying, hey, I need a facility with you for 6 months, 9 months, 12 months? Or is it the type of thing where it's deal specific, where they can say, my best guess is the IPO is going to be in 6 months, but if that schedule drifts, you can marry along the term in how should they be thinking about that when they come to you?
Yeah, it's a great question, and it comes up quite often when we're talking to folks that have very large positions in promising companies, and the concern is there a fixed term on a financing transaction like this? Because the liquidity event, though they may be planning towards an exit in some time frame, is still uncertain, and the big concern is, oh, okay, well, if I go out and I get some type of financing secured by the value in my private shares and say it has a 3-year term or a 5-year term, what happens if the company is doing really, really well,
Right.
and you get to that 3 or 5-year term and the company is still private?
Right.
And if there is a term structure assigned to a transaction like this, that is a legitimate concern, because a lender will say, well, we don't think that's going to happen, but if we do get to that term, we'll have to negotiate an extension, a modification, precipitate a secondary sale to get that financing paid back.
Mm-hmm.
Which is problematic, because the shareholder in their relationship with their financing partner, if there's a fixed term, they don't have a lot of leverage in that discussion.
Yeah.
Right. The lender, the financer, holds all the cards. So what we've done at Liquid is we don't have a fixed term. So the maturity or the payback point is tied to an event rather than a point in time.
Hmm.
So it's tied to the liquidity event itself, whether that liquidity event happens in 1 year, 5 years, or 15 years. So, we get comfortable with holding that investment until there's ultimately a liquidity event in the future.
And and forgive me for getting somewhat detailed, but how much of a line of sight do you need to that liquidity event? Is it one, a function that the company has so much momentum that it's just assumed to be inevitable, or do you actually need, to meet with the bankers where they say, yeah, no, we're planning in 6 months, we're going to list? I mean, how much detail and granularity do you need in that?
Yeah, I mean, we need to be comfortable that from an underwriting perspective, that there's a good chance for a liquidity event within a 3-year time frame. But that's really just an estimate. The liquid team has been doing this, for almost 20 years at this point. So we've seen all kinds of situations, and the parameters have always been in place. The expectation that there could be a liquidity event in 36 months, and sometimes it happens very quickly. Other times it takes significantly longer than that. But what that parameter does is it focuses us on later stage companies. Companies that have completed a Series C or a Series D round. They've got fairly significant revenue, good growth rates, good margins, all the indicators of, there could be a liquidity event on the horizon.
Got it. And this is, so given what we've seen this year in the SPAC market, are you indifferent in terms of the type of liquidity event? Could it be an acquisition? Could it be an IPO? Could it be a SPAC? I mean, as far as you're concerned, you're agnostic?
We are. We're actually agnostic, not only to the type of liquidity event it is, but also what the use of the money is for. For us, if you think about it, it's an asset-backed transaction. It's about the quality of the company, the amount of collateral, and the amount of capital we're willing to advance against that. In fact, we just had one of our portfolio companies de-SPAC yesterday. So a very promising payments company, and kind of went through the SPAC process, and now it's trading under its new name. So we're excited for our counterparty. We're excited for the fund. But yeah, it could be a traditional IPO. It could be an acquisition. It could be a direct listing. It could be a SPAC, in terms of the type of the type of liquidity event.
And given, if we just again drill into detail again, given how global the markets are, where is there a specific geographic sweet spot for you where you say this is the type of counterpart that we work best with? Or given, for example, DD just listed this week, we're expecting Grab to vis-a-vis the altimeter deal. We're expecting their de-SPAC transaction to conclude later this year. So there's going to be while listed in the U.S., there's going to be a lot of overseas wealth created. Is liquid stock something that is just particular to the U.S., or is it something that these other executives, as they list in the U.S., should be looking at as well?
Yeah, our focus, has historically been on U.S. companies, simply because they're in our backyard. And there's a lot of opportunity here, and we've done numerous transactions with individuals that have worked and led U.S. companies, but they were not situated in the U.S. And it's only natural to take that next step. The thing that's important on our side, if we're looking to advance against a certain amount of private stock collateral, it's that our interest in that collateral is something that works from a risk management perspective.
Got it.
So
And
it's about the safety of the collateral for us. Yeah.
And do you actually logistically receive the collateral? I mean, are they assigning it to you, or do you effectively have a call on it, assuming, God forbid, there's a default? I mean, logistically, how does that work?
Yeah. So what we're receiving is a pledge. And getting back to the earlier point, for us, it's about the enforceability of that pledge if these are non-U.S. based companies. So we're receiving only a pledge of those shares, and sometimes it's not an effective pledge until the liquidity event happens. So you think about it from the fund's perspective, we're just trying to manage counterparty settlement risk. So we want to make sure we have a secured interest in something when we go to settle. So with the companies that we've worked with and individuals in those companies, we can either get a secured interest immediately while the company is still private, if that's something the company itself is amenable to, or we have a mechanism that when any pledge restrictions in the company go away, which is typically upon a change of control, we do attach to that asset prior to settlement. It's important to note let me just back up a little on kind of how we structure our deals and the way the cost of our capital. So there's two components. Like any financing, there's an interest rate like component that accrues over the life of the transaction. And in our deal, in our transactions, we're taking venture risk. We are putting capital to work that's backed by private company shares. So there's venture risk and there's timing risk. Though we may hope and expect that there will be a liquidity event within that 36-month time period, that doesn't always happen. And because we don't have a fixed term, we're waiting to the liquidity event, there's some timing risk. And in return for that, we want to align everybody's interests. We want to have, we'll take risk in the deal, but we want to have upside in the deal as well. So there's an equity sharing component to our transaction. Now, the way we get that is that we're never a shareholder. There's never a transfer, which is important, not only to companies but to individuals as well. That they continue to have all the benefits of stock ownership and own those shares, have the rights tied to those shares. So we are just looking to have a secured interest in that underlying position at the end of the day.
And actually, let's if we can, let's just flip quickly to the other side of the table. So in the context of investors in your funds, so you do have LPs that have provided you the capital. How do they think about the composition of your fund from an asset class perspective? Because this just isn't like I could kind of tongue in cheek quickly say from their standpoint, this is a high yield portfolio where, due to your credit work, it's not high yield, but you're making the spread as if it was a high yield portfolio. But it's not that simple. It's not just a fixed income portfolio. I mean, how do they see it, and what's the value add for them?
Yeah, it's from my perspective, it's something of a hybrid, and from an investor's perspective, it really depends on where they're coming from, because you could look at it like credit with equity participation, or you could look at it like equity with downside protection.
Good point.
People very much self-select into one of those two buckets. I like to say it's got and I know it's an overused term, but it has our security from an investor standpoint has a true asymmetrical risk return profile, which doesn't map directly to equity or debt or credit. So we are providing financing. It is backed and over collateralized, so there's downside protection, but there is equity participation as well. So the investors that work and are interested in us really buy into our investment thesis. How can we get equity participation in the most promising later stage venture-backed companies with uncapped upside, but also have something close to 2/3 downside protection based on valuation. You can pick a later stage, just high valuation, fast growing company. In today's world, it could be valued at 20 to 30 times revenue. You can have a healthy debate as to whether that company is overvalued or not. if you were going to buy the shares at today's value. With our security, you can get some level of participation in the future of that company through the equity participation. But if the company ends up being overvalued at the end of the day, 2/3 downside protection in valuation before our fund loses money. So it's a very unique security. You don't have as much upside, but you have substantial downside protection.
And with that, if and I'm going to flip to the other side of the table to ask you one last question. So the viewers watching this today can really run the gamut. So this could be the CEO of a unicorn that's planning, as you alluded to earlier, any number of permutations as far as the liquidity event is concerned. At the same time, you and I both know you have those large founding shareholders that are there. Is this something as well that the folks who run HR should be looking at? Is this something where they might say, is this just limited to those large shareholders, or is this something where the company can think of this and say, hey, this is actually a liquidity solution for the employees? So where's your sweet spot in terms of who that counterpart would be, and especially given some of the folks we know who are going to listen to this broadcast?
Yeah, it's a great it's a great question. It's also a timely question. The trend that we have been seeing over the years is more and more companies are getting interested in this type of financing solution to either help their option holders become shareholders. And I can tell you, if you're an option holder, you'd much prefer to be a shareholder. And also to help with liquidity needs. So we help take option holders, turn them into shareholders. It's actually a share purchase program. When we do that, we're an alternative to a company-sponsored liquidity program where companies want to give their employees a choice. It's not, hey, you can sell 15 to 20% of your shares today at X price, or don't sell, right? The choice would be, well, you could sell today at this price, or here's another avenue to get liquidity where you maintain more of your ownership of the company going forward. And you think about that from a company's perspective, right? They want people holding more equity, not less equity.
Right.
But they also want to meet individuals' liquidity needs. And this is an avenue to do that. So we see companies that are considering repurchases or company sponsored liquidity events, saying, look, let's give our employees a choice. We're an employee first culture here. We want to do the right thing by our employees. They're telling us they need liquidity. Let's not just put up one alternative or one avenue. Let's give people a choice. And for people that are very excited about the future, the financing alternative is something that they should consider relative to a sale.
And forgive me, I want to sneak in one last question because you just reminded me. So as a principal, I'm watching this broadcast and I say, fantastic, I want to initiate a discussion with Bob and his team at Liquid Stock. Manage their expectations. How long could the process take? So between that initial call, and let's assume for a second it's a company that you say, this is a terrific counterpart, we're very excited about it. Soup to nuts, how long could the process take?
Yeah, so there are a couple of different steps, that could potentially take time. What I'll say is we have turned around transactions in a matter of days, and we've gotten involved in situations where it's taken many weeks. So if it's a company we're excited about, a company that we've already underwritten, that tends to be on the shorter end of the time continuum. If it's an opportunity and maybe a company we've heard about, but we need to do our research. And if we have access to financial information, a data room, we're going to go through a traditional valuation process. Not as deep as a preferred round investor, but we want to put a value on what a share of common stock in the company is worth. And that process can take a couple of weeks, assuming we get access to the information immediately and do our work. The other part that takes time is just on execution. So all of our counterparties will have legal representation and tax representation, and our document review If somebody is, if you're working with, say, an attorney who's very familiar with secondary transactions, they could look at our transaction documents and say, oh yeah, this makes complete sense. I've seen things like this, and that can move quickly. And we've seen other situations where people are just kind of getting their feet wet and learning it, and that process can stretch on to take a couple of weeks.
Fantastic.
So anywhere from a couple of days to to 3 weeks is probably a good range for folks to think about.
Got it. And I'm smiling as you say that because, and I know some of our listeners are going to be from some of the Swiss banks, so you are still lightning fast relative to the process for a typical private bank to turn around and answer. And Bob, let me sneak in one last question. Size-wise, where's your sweet spot? So let's assume again, I'm that individual. I have a terrific company. I want to initiate a conversation with you. Manage my expectations regarding size in terms of what you would feel comfortable talking about.
Yeah, so there's a range, and just a snapshot on the structure of liquid stock. We're set up as a traditional venture fund. So our current fund, which is almost fully deployed, was 161 million, backed by tier one investors, real solid institutional investor backing. So just thinking it from a portfolio management standpoint, we would like to establish positions that are in the the $5 to $15 million range per company. Sometimes that's one individual, sometimes that's multiple shareholders. But to put that in perspective, we have done transactions that were less than $500,000. And prior to this specific fund, the single largest transaction we worked on, one individual shareholder with, was about 75 million. Our investors in Fund One were always interested in co-investments. So if it's a question of, is this too big, our investors would step in and on a co-investment basis. And we're beginning the process of raising our next fund. And that'll be twice the size of our current fund. So we can do large transactions. We're also interested in smaller ones because that's the transaction that can get us introduced to a company and get us through the diligence process. And then our counterparties over the years have been our best referral sources. Come in, do a good job, structure a deal that's a win-win for people, and word gets out pretty quickly. And that can be the entree to the company, and we can build a position from there.
Fantastic. Well, Bob, this has been great, and I'm embarrassed to say, but you know me well enough to tease me about this. Every time we talk, there's another nugget that I realize I didn't know about liquid stock. So again, thank you. You gave me several here, which were actually very helpful. And for those listening today, we, in addition to this conversation on our end, we have materials on our website. We have a data room set up that includes Bob materials at Liquid Stock. We're more than happy to introduce you to Bob and his team. So feel free to reach out to me or to Bob directly to follow up on that with any questions you may have. And it's very easy for us to set up an offline virtual meeting, especially in today's COVID world. So Bob, again, thank you for your time. I promised you half an hour and I lied because we ran over that time. And again, I look forward to having this conversation again in the future, and look forward to speaking next.
Well, great. Thank you. Thank you so much, Frank.
Okay.